Happy day, everybody, and welcome back to Mortgage Talk with Mark. And glad to be back in the studio. My guest actually had to reschedule, so I'm going to go solo today. And when I go solo, I talk about the subject of the title, which is mortgages, because that's what I've been doing for the last 40 years. So I thought, well, what I'll do is I took about 10 questions. I wrote down 10 questions that are very common that I've heard over the years, very standard sort of questions people to ask, and maybe give you a little insight to your situation. And if I can help you, of course, you reach out to me about purchasing or refinancing or building homes, whatever you do around the residential side, let me know. And so I'm going to start with probably the most common question when people would call, even people who've owned homes before, because it is somewhat of a mystery. People don't buy properties all the time. It's not something they do, every few months or every even few years. So even people who have experience in buying properties have this general question, certainly first-time buyers, and it's kind of phrased as, how much can I qualify for? And that's really a good place to start, mainly because the typical process of buying a property, people, including myself, this is the way I've done it in the past too, we go online and we start looking around to see what's available. We may go to neighborhoods and look at open houses, or we may go on Zillow or some of the online portals for properties to search around, and we say, I want to live in this area, and this is kind of the size of home I want, near the schools I want, et cetera, et cetera. But people that come to me, at least in the last couple of years, are sort of shocked by how much their payments are based on what they want to look for. So I always recommend get your mortgage in place first. So you'll have your budget established, and you'll know approximately how much you want to borrow based on your budget for housing. Is that $3,000 a month? Is it $2,500? Is it $5,000? People have all sorts of budgets, but everybody has a budget. So start with that. And so the way it works, typically speaking, is we're going to take 50% of your gross monthly income. And let's just make the math simple. Let's say it's $10,000 a month, either yourself or with your spouse. Gross income before they take out, your employer takes out taxes and insurance and other benefits, things like that. So it's the gross income. And let's assume it's $10,000 a month. The lender is going to take 50% of that, a ratio of 50%. It's called debt to income. The debt to income, or DTI, is 50%. So that would give you $5,000 a month, which has to cover your outstanding debt. And when I'm talking about debt, I'm not talking about utility payments or gym memberships or things like that. I'm talking about debt that you have in consumer debt, like student loans, car payments, credit card bills, any kind of personal debt that shows up on a credit report. That's why we run a credit report, to see your score, number one, but also to see what kind of debt structure you're carrying. So let's say that you have $1,000 in consumer debt. You have a car payment of $700 and some other $300 of minimum credit card payments. So it's $1,000. We'll allow you to borrow up to $4,000 for a mortgage payment in that scenario. That may not be in your budget. You may say, well, Mark, I want to spend $3,000, of course. So you can borrow anything under the $4,000. That's your maximum borrowing power, would be $4,000 a month. And the other rule of thumb is approximately 90 basis points, or 0.9% of your loan amount, is going to be your monthly payment. So as an example, on a $500,000 mortgage in today's world, with interest rates where they are, and property taxes and insurance and all the things that go into a mortgage payment, including HOA, it's about 0.9% of the loan amount monthly. So in other words, on a $500,000 loan, not house, it's after you make your down payment, you're going to borrow $500. Your monthly mortgage payment is going to be around $4,500 a month. Okay. If you borrow $400,000, it'll be around $3,500 to $3,600. So that's a rule of thumb. And I'm hearing a lot of people, like my scenario before, they go out and they look at properties, but when they come to me to get a mortgage loan and get pre-qualified or approved, the payment's a lot higher. So I always say, come to a lender first, whether it be me or somebody else, and get your budget down. Do your finances, understand exactly kind of the long-term cost of mortgages of a home too. If you've never owned a home, there's going to be some deferred maintenance, possibly. There could be, unless it's a brand new home. If you're buying a brand new home, of course, there's warranties. But if you're buying a resale property, there's going to be some home warranty. But there's also going to be long-term maintenance, and could be as simple as air filters, but in that case, it could be air conditioners, which gets expensive. So that's kind of the rule of thumb on how much you can borrow, and always get that in place first. And then there are some other types of loans that don't have a lot of requirement for qualification of income, but we're going to talk about that maybe in just a second. But the second most common question that comes to me typically is, how do I shop around and get the best deal? And I highly recommend people shop around. As a matter of fact, I've talked about this before in previous shows, but I wrote a white paper, what I call a consumer guide, called The Truth in Lending, where I share my 40 years experience in the mortgage industry and teach people, how to shop around for a loan. And I start with there's three basic channels of mortgage loans. There's your commercial banks or credit unions like University Federal Credit Union, Bank of America, Chase Bank. All the institutions of banking not all of them, but most of them provide mortgage financing as well. They used to not in the old days, but they do now. It's a good place to start, possibly, if you bank at Chase, like I bank at Chase. And now, obviously, I'm not going to go there for a mortgage because I'm a mortgage broker, but that may be a place to start. The second conduit or a channel of mortgages is called a mortgage banker. And a mortgage banker is not a bank per se. They're not a depository. They don't take in money like a Chase Bank or Bank of America or credit unions. They have large warehouse lines of money that they can access to loan for just home loans. That's all these people do. And I've worked for several of them over the years, and there's some very good companies out there that are mortgage bankers. And the third category is somebody like myself. This is the third channel of loans. This is probably the smallest channel because it's a little harder to get in this business. It's called a mortgage broker. A mortgage broker is independent of any one institution. In other words, I don't work for a bank or credit union or a mortgage company. I work for myself, and in that case, I work for the consumer. And I have about 20 different lenders around the country. They're called wholesale lenders. And wholesale, of course, means typically lower fees or lower costs. In this case, there are lower fees in rates using a wholesale lender as opposed to a bank or mortgage company, because we cut out the middleman. There's no other people involved in the process between me and the end user for you. And so I shop out loans based on your qualification. We'll talk about that in just a little bit. But to get the best deal, you want to make sure that you talk to at least 2 or 3 different sources. And also, they're going to run your credit, and don't worry about that so much. We run what they call a soft credit pull, which means it will not hit your credit score. It doesn't ding you. It just gives us an idea, a snapshot of your credit score, and it will give us an idea of your current debt structure. So look around different places and decide which is best for you. Now, there's also a lot of confusion about what the best deal means. People think that means the best rate, and that's not always true. A young man came to me a few weeks ago, first-time buyer in San Marcos, and he said, "Well, Mark, my this online lender, I forget who it was, gave me about an 1/8% better than you're offering me." I said, "Well," his name's Tyler. I said, "Tyler, let's look at the full package. Okay, are you looking for the lowest rate or the APR?" And he didn't understand what that meant. The APR stands for annual percentage rate, which is a total overall cost of the loan, including the closing cost. So sometimes a lower rate, in this case, they were charging about $4,000 to buy down that interest rate. I was not charging any fees to buy down the rate. So my rate at the time was 6.5. He was getting 6.375, but he was also spending $4,000 extra to get that rate. So the overall cost of that loan was much higher. The APR in his case with that lender was around 7.1, and mine was 6.8, which means that the APR is a calculation of all the fees, the one-time cost of doing that mortgage plus the interest rate. So when you shop for a mortgage rate, you really want to shop for the APR. The lowest APR is your best deal. Okay, that's comparing apples to apples. And then another question that comes around is around credit score. Now, credit scoring is sort of a mystery. It's a mystery to a lot of people. Now, there are some professionals that I refer to if people need to raise their credit score. There's companies out there, that's what they do. They're credit restoring, credit repair companies. Now, there's a lot of fly-by-nights in that industry for sure. So if you need credit repair, give me a call because I can recommend some very professional companies with a lot of integrity. That's what they do. But they have not formulas so much, but they have strategies on helping people with their credit score. There's 5 uh, basic pieces to a credit score. And also you want to look for is what they call the FICO score. FICO stands for Fair Isaac Company. And Fair Isaac's been around for a long time doing credit models. And we've been using FICO scores and mortgage underwriting for probably 30 years now. I forget, but long, long time. And there's 5 essential pieces to it. Number 1 is do you make payments on time? If you miss a mortgage payment or you miss a credit card payment after 30 days, there's a 30-day window before they'll count it late. But if it's over 30 days, they ding you as a late payment. That's going to hurt your scores quite a bit. If you have any sort of collection or a foreclosure, certainly, or any sort of credit that goes back to the lender, that's going to really hurt you hard. So the first thing to do is keep your payments on time for sure. Even if you make the minimum payment, if you have $1,000 Visa card, but then the minimum payment is $30, at least make the $30 payment. Don't let that slide by, or the scores are going to go down very quickly. The second part of that is the type of credit you use. And lenders like to see that you use a variety of type of credit, installment loans like a car loan or a student loan possibly, along with credit cards or revolving non-secured debt like a Visa or Exxon or anything like that. And you want to have several lines of credit keep your balances low. That's the third thing they're going to say. Well, how much do you owe versus a line of credit? So if you have a $10,000 Visa, ideally, in a perfect world, to maximize your scores, you don't want to keep a running balance on average over $2,000. That would be sort of the optimal place, around 20% of what you're allowed to spend to actually have a debt on, about 20% debt on that. So, and don't keep one card with a high debt and the other one paid off. So if you have a credit card with two credit cards with $10,000 available credit, don't have one with $9,000 and one with 0. Okay, balance it, if you will, as best you can. Ideally, you want to have it. People do have credit card debt. As a matter of fact, we are in a historic place right now as far as revolving unsecured debt goes in the country, over $1 trillion. So there's a lot of consumer debt out there. And that's one reason people are starting to refinance a lot. We'll talk about refinancing as well. But even if you have a lower mortgage rate right now, you could refinance and pay off, have a client paying off $60,000 right now before of credit card debt that he's accumulated the last few years ever since COVID. So his mortgage payment is actually coming down, even though his mortgage rate's a little bit higher than he has on his mortgage. He just wants to clear all that debt out. So that's what we're doing for him. And so you also want to look at obviously the types of debt and making your payments on time. So that's the way you want to. Credit scores are a very, very fluid thing that can change day to day. In other words, if you pulled your credit today and you made a payment tomorrow and hit the next day, it reflected on your credit bureau, then your score would change. So it's a very fluid thing. And some people get confused a lot of times. Matter of fact, I hear it not every day, but almost several times a week, where they say, well, Mark, my credit score is 720. And what they're referring to is they go online and they pull a report to a consumer company like Credit Karma, or even credit card companies will give you a credit score like Discover, or a lot of different credit card companies will also give you a credit score, but they're not giving you a mortgage score. They're giving you a consumer score called the Vantage score, which is different than a mortgage FICO score. So there's different algorithms out there in the marketplace that score credit. And but we go, and all lenders use the same one. And the secondary market who buys these loans, they're the ones that determine the guidelines, and their guideline says we're going to use this scoring model. So if you go to me, or you go to Chase, or another mortgage company like Fairway as an example, Fairway Mortgage is a good company. They're all going to run the same model. So your scores are usually good for 90 days. Now, I had a situation. I had a client pre-qualified back in May. His scores were around 630, but he qualified under an FHA model. And now he sold his house. He's looking to buy. This is about 4 months ago. Now, I had to rerun the credit because it expired, his report. And now he's below 600. He missed a payment in that window there. So now we're going to have to work on some credit repair for them. And, it's a shame, but That's what happened. He didn't. An old bill went into collection actually, and so we're gonna work on some strategies to get those scores up. And there's ways of doing that in the next 60 days. Again, some of these companies that I deal with on that side of the business, the credit repair business, are very, very good, and they can help people very quickly. So again, don't give up. But if your scores are under 580, you're going to have a hard time getting a mortgage in today's world. In the old days, we could do that, but now lenders like to see up to at least 580 on what they call the FICO score. The FICO model runs from 350 to 850, and I rarely see anything in the 800s. That's be extremely, extremely good credit. Most people average around 700. That's the kind of the state average in Texas is around 700 on a FICO model. But if your scores are under 580, you're going to need to do some work to get those up. And there's ways of doing that. So again, if you're really serious about buying a house, whether it be in this year in 2025 or next year in the near future, that's the first thing you want to do. And that's the first thing we do as part of the qualification is to get your credit run, along with the other data we'll ask for. And so let's kind of talk about that. Let's talk about the types of mortgages available. And there's 4 fundamental types. Well, there's actually more than that. But the 4 fundamental types are going to be conventional financing, FHA financing, VA financing, and what they call non-QM. Okay, we do a lot with non-QM. We'll talk about it in just a minute. The first 3 are what we call agency loans. An agency loan is one that is purchased by the secondary market from all sorts of mortgage lenders around the country. The secondary market's role is to create liquidity in the marketplace for lenders to do more loans. So a mortgage loan is a commodity, which is once we make it, we close on it and we loan you $300,000. Okay. Well, that $300 is not on the books per se. It's not like an old savings loan that used to hold the loan in house. It's going to be sold to the secondary market so they can get their money back to make more loans. That's how the business is done. And the secondary market is called the agency. That's what we call it, is agency loans. And those guidelines are such that they're handed down to different lenders, and pretty much the guidelines are the same. It's kind of like the IRS. They make the guidelines, and then the CPA will interpret those guidelines and help you with your tax return, as an example. So conventional loans are usually a very good product for people who have very high credit scores. And I mean high credit scores. I mean 760 to 780 are going to be your optimal rates. Rates are a function primarily of credit score. So the credit model is very, very important when it comes to getting the best deal. So if you have time, if you're not in a hurry to buy, I would still get pre-qualified, look at your score and maybe get it up 30, 40, 50 points over the next few months. So when you go to buy a property and contract on a property and actually close, you'll have a much better deal on your rate. Conventional models are such that if with lower scores, the rates are going to be quite a bit higher. So that's one option. But also as well as they only require typically 5% down. 10% down will get you a little bit better deal. So the more you can put down on conventional, a little bit better deal you're going to get typically, especially around mortgage insurance, because mortgage insurance is required on any kind of conventional loan unless you put down 20%, generally speaking. So keep that in mind as well. Most people, we can do loans as low as 3% down, and actually one conventional product, which is USDA, requires 0% down, but there's lots of other parameters around that type of loan that we can talk about aside. The second probably most popular loan in Austin, well, certainly Central Texas, would be FHA. FHA is generally not designed for, but a lot of first-time buyers will qualify under FHA, mainly because the qualifying is a lot easier. They're much more lenient on credit scores and down payment, 3.5% down, and the rates are very, very good. Actually, the rates are a little bit better than conventional, but they do have 2 types of, if you will, mortgage insurance. It's not called that. It's called MIP, which is mortgage insurance premium, as opposed to PMI, but that's another conversation. But there's fees involved, because the fees also are insurance to protect the lender in case of default. So the client, the borrower in this case, has to pay what they call MIP fees on FHA, which it's a government-backed loan. So the government's backing these loans in case of default to the lender, so that they collect all this insurance. It's like any other insurance. If there's not a default in that loan, then the money stays in the kitty. But if there is a default on the loan, let's say somebody has to go to foreclosure or can't sell their house and they can't make the payments, then the loan will go back to the mortgage company. And the mortgage company is insured that they're going to get their money back from the federal government through this thing called MIP. But the FHA loan is very desirable, typically amongst first-time buyers. I've had them in the past. My very first home in 1990, I got an FHA loan because I had a little bit of money. I had decent credit, wasn't the best credit in the world, but I was able to qualify because the debt-to-income ratios are also more lenient too. So they'll allow you to carry a little bit more debt than conventional financing. So again, it's a little broader scope of of underwriting than a conventional loan. And the third type is VA. Now, Texas, a lot of people don't know this, but Texas has the second most number of veterans in the country behind California. So Texas has a lot of veterans who qualify for VA. I don't qualify for VA because I wasn't a veteran. So you'd have to be in the service. There's guidelines of how long you had to be in the service and whatnot, what kind of, if there's wartime or peacetime, there's all sorts of guidelines. But if you qualify for a VA loan, that's absolutely going to be the best loan for you. And I've done hundreds of them over the years. You know, there's a lot of veterans in Central Texas, with Fort Hood being up the street there in the Temple area, Bell County. And of course, down in San Antonio, they have a lot of Air Force bases down there. So there's a lot of retired veterans here. And I did a loan for a man. He was 65 years old and he'd never used his VA. He's retired veteran, retired from the state. After that, he worked for the state of Texas, and he can use his VA loan with zero down. So it didn't cost him any money. That's the benefit. One of the great benefits of VA, there's no money down, and the interest rates are very, very good. And there's no mortgage insurance. In his case, he was a disabled vet. He was actually 100% disabled. And the advantage to him, and this is rare, but I see it more times than I used to, 100% disabled veteran does not pay any property taxes in Texas. So the property taxes on his house was around $8,000, would have been. In his case, they waive it. And every lender should be able to waive that because that's a state regulated benefit for veterans with 100% disability. And so if you're 50% disability, you'll get a discount on your taxes, but you also won't pay any what they call funding fee, which is the VA's sort of method of insuring their loans. It's called a funding fee. But veterans, if you're a veteran and qualify under VA benefit, they used to call it the old GI Bill, and it's been around since after World War II. It was proposed by Congress back in the 40s in order to bring all the servicemen back who wanted to buy homes. They allowed them a special type of loan, which we still have today, called a VA loan. And there's two advantages also of FHA and VA that you don't have with conventional. And we're starting to see this a lot right now that we're doing loans back in 21 and 21, 22, early 22 for sure, where we're doing mortgage loans around 3% or less. The lowest loan rate I ever did for a client was back in February of 22, I think, at 2%. So very cheap money back around the COVID days. That's all changed, obviously. But the FHA and VA loans are also qualifying assumables. So if you want to sell your property in the future, then somebody, as opposed to coming to me for a mortgage rate at 6%, as an example, could pick up a 3% mortgage. If they qualify, they have to go into the lender and do this, same paperwork they would do with me, but they would be able to pick up that mortgage rate. I did a loan for a young man who's with Randall's. He manages one of the Randall's stores here in town, and he's being transferred to Dallas. Well, his rate on an FHA loan back in, 2022, somewhere in there, was 2.25%. So he was able to sell his property, and the borrower paid the difference between what he owed and the sales price, which was around $30,000. It wasn't a whole lot of money, but it was something. He walked away with his $30,000, and the new client bought that property at the 2.25%. He didn't come to me; he went to the servicing company and directly qualified. So that's the advantage of an FHA and a VA type of loan, where somebody could assume it. It's not always the best case, but generally it's in the last several years has been. Another question I get around is a lot about employment history. People think they have to be on their jobs for a long time, and that's simply not true. What we do, and this has been the case for years, we look back 2 years on employment. Now, if you're self-employed, we're going to want 2 years of tax returns to show your income as a self-employed borrower. But for a W-2 employed, We're still going to go back to look to 2 years, but you don't have to be on the same job for 2 years. I just closed a loan with a young lady who works as an orthodontist. She's not an orthodontist. She works as a dental hygienist. That's her job. And she'd been with 4 different dentists in the last couple years. And she moved for a variety of reasons, some for increased pay, some for geographic reasons to be closer to her home, things like that. We had to verify that she worked at these different places for the last 2 years, the same line of work. So she'd been doing dental hygiene work for a long time. In the last 2 years, she'd been with 4 different dentists. So it's a little more paperwork, a little more legwork to get her approved because we had to go back and do verifications of employment, but she's still qualified, and we closed on that property in Wimberley in July. So employment history is real important. Now, where it gets a little tricky is sometimes people are employed, then they go off on their own to become a consultant. Let's say an engineer who works at a company, and they go off and become a consultant. We're going to need to wait for at least a year for them to show how much they can make as a self-employed contractor. So there's a lot of considerations around employment history, retirement income, things like that. So we're going to look at 2 years of income, whether it be pension income, Social Security income, IRA distributions, capital gains, anything people do for obviously wages and tips and things like that if you're in the service industries. So I've only got a few seconds left here. If you have any questions, my name is Mark Hairston. My phone number is 512-789-6967. You can find me online at Mark Hairston Mortgage Lender. And my email is mark@markhairston.com, HAIRSTON. See you next week.